Good afternoon, everybody. Thank you, Melissa, for getting everything set up. This is Jerry Marlett. I'm a partner at Mayer Brown. First, I think I would like to give special thanks to Stuart Cutler, who's joining us today. I've known Stuart for more than 25 years. He is an icon in the commercial paper business, and I'm especially pleased to have you here today. Thank you, Stuart. Thank you also to some 200 registrants. I appreciate you guys joining. And a special thanks to some old friends that I see on that list that I've worked with over the years. So let's turn just quickly, if you will, Melissa, to slide 29. I just want to give everybody a sense of what the commercial paper market is like today. This is, as you can see, a table from the Federal Reserve. It gives us commercial paper outstanding for periods, from August through January 20th. And it breaks it down by non-financial, financial, and asset-backed issuers. And if you look at this, you will see that about 60% of the issuance is from financial institutions, about 20% from non-financial corporate issuers, and about 20% from asset-backed issuers. And you'll see that foreign financial institutions are almost 2/3 of the total issuance from financial institutions. That just gives you some feel for the size and the shape of the market. So let's go back to slide 2. I'm going to talk about the federal securities laws that apply to the issuance of commercial paper. Stuart is going to talk about the much more interesting thing is what the markets are like, who the investors are, who the issuers are, and how commercial paper is primarily being used today. So what is commercial paper? It's a term that tends to be used to refer to corporate short-term debt with maturities typically less than 12 months. In 1933, commercial paper meant debt securities that were issued under Section 3A3 of the Securities Act. Since 1933, there has also developed what is now a significant market in short-term corporate debts issued under Section 4A2 of the Securities Act. There are differences between the two types of commercial paper in terms of investor base, use of proceeds, and the securities law requirements that apply to the issuance of the commercial paper. Next slide, please. Commercial paper actually has fairly deep historical roots. I've seen references to commercial paper going back to the 1860s and perhaps earlier. And it related to the sale of commercial paper, that is corporate obligations, purchaser obligations to pay a manufacturer in 30 days or 60 days after delivery of goods. Commercial paper was issued by merchants and manufacturers for short-term financing of operations. And by the 1920s, commercial paper was sold primarily to banks through commercial paper dealers. In 1933, with the drafting of the Securities Act of 1933, there was a concern that a short-term paper that arises out of or finances current transactions and something that's rarely bought by private investors were required to be registered under the Securities Act would radically interfere with commercial banking transactions. Commercial paper has been a part of at least it's been contemplated by the Federal Reserve System, starting with the initial Federal Reserve Act of 1912, which included commercial paper as an instrument that was rediscountable by Federal Reserve banks, meaning that a bank that was holding commercial paper could take the paper to the Fed window and borrow against it. In 1933, the Federal Reserve drafted an exemption for commercial paper, and provided that language that eventually became Section 383. Next slide, please. Section 383 provides an exemption from the registration requirements of the Act 4, and there's a quote there of Section 383. A couple of items to note there. One, it's a note that arises out of or finances a current transaction, and that's a key to Section 383. And it has a maturity at the time of issuance not exceeding 9 months, exclusive of days of grace. In 1961, the SEC in a release added color to that requirement in Section 383, where it said that the legislative history of the Securities Act makes clear that Section 383 applies only to prime quality negotiable commercial paper of a type not ordinarily purchased by the general public. That is, paper used to facilitate well-recognized types of current operational business requirements and of a type discountable by the Federal Reserve banks. In particular, the prime quality requirement here will come up at several points later in the presentation. The staff of the Commission has interpreted Section 383 to exclude as not satisfying the 9-month maturity standard commercial paper that has an automatic rollover provision. Next slide, please. So the SEC imposed 6 separate characteristics in that release as qualifying securities for Section 383. 1, it had to be negotiable. 2, it has to be prime quality. 3, it has to be eligible for discount at the Federal Reserve banks. 4, it's not ordinarily purchased by the general public. 5, it's used to facilitate current transactions. And we'll talk about what those are in just a moment. And finally, the maturity has to be 9 months or less with no automatic rollover. Next slide, please. So let's talk for a moment about current transactions. There's a long series of SEC no action letters that define current transactions for various different kinds of businesses. For banks, for nuclear power generating entities, for construction companies, for a wide variety of different types of issuers. And traditionally, it was necessary to trace the use of proceeds from commercial paper to identifiable current transactions. Over time, that evolved into what we now call a balance sheet test. And following a 1986 staff response, now it's only necessary to demonstrate that current transactions on the balance sheet exceed the amount of commercial paper outstanding at any time. So current transactions are generally viewed as inventory, accounts receivable, also operating expenses such as salaries, short-term loans, federal, state, and local taxes, and various types of bank loans with maturities not exceeding 5 years. Importantly, however, for Section 383 commercial paper, the proceeds cannot be used to finance an acquisition. Next slide, please. Section 383 provides an exemption from the requirement in Section 5 of the Act to register any offer or sale of a security with the SEC. Importantly, Section 383 commercial paper is not a privately placed security. It's deemed to be publicly offered, although not required to be registered. This is important, for example, in connection with the 40 Act, with the exemptions under 3C1 and 3C7, which restrict those exemptions to an issuer that's not making a public offering. To meet the not ordinarily purchased by the general public standard, commercial paper is normally issued with minimum denominations of 100,000 or more, although occasionally you will see $25,000 minimum denominations. I would say today it's not uncommon, and perhaps even the majority of cases, I see minimum denominations of 250,000. 3A3 commercial paper is usually rated A1 to satisfy the prime quality standard, but we do see commercial paper rated A2 and below. Stuart, maybe you can just jump in for a minute and talk about how important that A2 commercial paper is to certain issuers.
Sure, and thank you, Jerry. So in terms of ratings characterization of the commercial paper market, as Jerry pointed out, right now corporate outstandings are approximately $200 billion and bank outstandings over $600 billion. The bank product typically A1, P1. The corporate sector is broken down more in terms of credit quality, as you can imagine. Top tier corporates, A1, P1, or those who have long-term ratings of single A, single A2 or better, represent about 2/3 of corporate outstanding. And A2, P2, and A2P and A3, P3 issuers currently represent about $70 billion in terms of that total corporate or non-financial CP outstandings. In terms of investor base, money market funds, which maybe we'll get to a little bit later in this discussion, are primarily focused on buying A1, P1, or better rated commercial paper. Non-money market fund investors, such as independent investment managers, corporations, insurance companies, and banks, can purchase A2, P2, and A3, P3 commercial paper, which typically provides a slightly higher yield than that A1, P1 prime quality commercial paper.
Thanks, Stuart. So, commercial paper is issued in a continuously offered program. Commercial paper issuance obviously occurred well before Rule 415, and it's a classic continuously offered program. Typically, the maturities have been on the short end of the spectrum in the 7 to 21 day range. It seems to me more recently that the bulk of the paper is issued in longer maturities. Stuart, your sense of that, I think, is that the bulk of the paper is now out in the 30-day range. Would that be accurate?
Yes. I mean, the majority of investor liquidity in the commercial paper market is sort of inside of 45 days. For top quality issuers, the prime A1, P1 issuers, the target maturities are in the 30-day range. Having said that, there's a tremendous amount of liquidity in the 1 to 7 day maturity, just as many people use the commercial paper market really as a corporate cash machine for funding very short-term cash needs.
So the Federal Reserve produces a lot of information about commercial paper. And if you go to FRB H-15, you can find that what recent typical maturity ranges have been. And the volume statistics are available at the link there in that I have in the presentation. Proceeds of commercial paper are often used to pay off maturing commercial paper. So that keeps the outstanding levels of commercial paper fairly steady. In the days before shelf registration, it would have been impossible to issue commercial paper this frequently if registration were required. And even today, the registration costs would be prohibitive considering the high frequency of issuance and the short-term tenor. Next slide, please. Since 1990, virtually all commercial paper is issued in book entry form through DTC or other clearing entities, Euroclear or Clearstream. I'm focusing today on U.S. commercial paper, but Stuart will talk a little bit at the end also about European commercial paper. The issuing and paying agent for a commercial paper program holds a master note signed by the issuer for the benefit of DTC, and it records on its records the daily issuance and redemptions of commercial paper. So unlike most securities offerings through DTC, where a note, a global note, is executed for each issuance, for commercial paper, there's simply one master note, and the outstandings are recorded on that master note, regardless of how many issuances are done. There's generally no involvement of counsel in daily issuances of commercial paper. Counsel is involved in establishing the program, but not in the daily issuances of commercial paper. Companies issue commercial paper by direct calls to the dealer's commercial paper desk. And upon agreement between the issuer and the desk, upon terms of the paper, dealers will buy the entire daily issuance and resell it to investors. Excuse me. I have known on some occasions when commercial paper dealers, when there's a lot of issuance going on, commercial paper dealers see a very quick buildup of a commercial paper on their balance sheet before they manage to turn around and sell it to investors. Stuart, can you give us a little color on the commercial paper desk and how it functions and whether they keep an eye on their balance sheet?
Certainly, yes. Once a program is established, the program provides for issuance on a daily basis, as indicated, with a call to the various dealers that are named to the program, and that program is essentially available and active indefinitely. So once a program is established, it has a continuous life in terms of its capacity to issue to dealers. We, of course, as a major dealer in the market, have hundreds of clients that name us as their dealer and whom they communicate with whenever there is funding need. The communication typically is in the form of either telephone or Bloomberg chat or email, indicating that issuers' funding objectives for the day, whether it's 30 days or even overnight or whatever. As a dealer, our objective is to place the paper with investors, institutional investors, such as I described earlier. Yes, we, of course, do have balance sheets that facilitate the continual offering process of the market. But having said that, our primary agenda as a dealer is to make sure that we have identified the investor universe that can buy an issuer's paper, and our role is to transition that new issue to those investors at the issuer's instructions on any given day. We certainly do have a balance sheet which can facilitate investor liquidity. So if investors need liquidity, they need cash and need to resell their paper, we provide secondary market in commercial paper, and occasionally in certain instances where we are and that's needed, we will purchase paper directly from the issuer on a given day, especially if it's late in the day or early in the afternoon and it's too late to find investor participation, and we'll sell it the following day. But yes, we actively are engaged in distributing the paper each and every day, and we do balance sheets that facilitate the smooth functioning and liquidity in the market.
Stuart, what's a typical issuance volume for RBC Capital and the commercial paper area each day? What do you normally see?
Well, I mean, in terms of yesterday's transaction volume in the commercial paper market in the U.S., I think it was 82 billion in total issuance previously, and that was Friday, which was the last day of the month. Earlier in the week, it had been over 100 billion in terms of total volume, total daily volume in the U.S.
That's a lot of activity. Thank you. Let's turn to the next slide, please. So we're going to talk now about privately offered commercial paper as opposed to 3A2 commercial paper. As I indicated earlier, since 1933, there's been a growth of a 4A2 commercial paper market. Historically, the 3A3 market was considerably larger and deeper than the 4A2 market because 4A2 securities are privately placed and they're restricted securities. Today, the two markets provide about the same liquidity, and I say the same liquidity I mean that the interest rate paid on commercial paper under 3A3 or 4A2 is roughly the same. The advantage of Section 4A2 is that the section does not have any maturity limitations on the paper that's issued. It's a longer dated paper, longer than 9 months can be issued, and the proceeds don't have to be used for current transactions. Most privately placed commercial paper is issued through Rule 144A programs, although some programs still issue to institutional accredited investors. Stuart, do you have a sense today of what the balance is between 3A2 programs and 4A2 programs?
So 3A3 programs, which, as Jerry pointed out, were sort of the origin or the original commercial paper issuance exemption, probably represent less than 20% of overall CP outstandings today. In terms of new programs that have been established over the course of the last years, probably 90% have been 4A2. And that is for two reasons. One, there's no limitation on the use of proceeds to current transactions. And as pointed out, it provides greater flexibility in terms of maturity, i.e. the ability to issue all the way out to 1 year as opposed to a 270-day maximum. And as Jerry just mentioned, investor demand for 3A3 versus 4.2 is virtually identical. In the past, 4.2 was viewed as an illiquid security because it was technically privately placed, but as market has grown and liquidity for large 4A2 programs has demonstrated, these programs have equal liquidity in the market, and investors do not distinguish in terms of liquidity between a 4A2 and a 3A3 program anymore.
Thanks, Stuart. Next slide, please. So prior to the adoption of Rule 144A and Regulation D, private placements were conducted under old Section 4.2, which is now 4A2, with resales to a limited number of investors under the so-called Section 4.1.5 exemption. This kind of sharply limited the size of the market and the number of investors in the market. Today, however, with Regulation D and Rule 144A and more modern views of Section 4A2, the private placement market is approaching the public securities market in size, not only in the commercial paper area, but in the debt markets generally. With the recent enactment of the Jobs Act, the prohibition on general solicitations under 502C applied to commercial paper issued under 4A2. Occasionally, issuers would trip over this limitation and make some kind of a public announcement about their program and have to stay out of the market for 30 to 60 days. Next slide, please. With the changes to Rule 506C, that problem has largely gone away. Title II of the Jobs Act of 2012 directed the SEC to eliminate the ban on general solicitation and general advertising for certain offerings under Rule 506 and under Rule 144A. The Rule 144A exemption has actually proved a lot more beneficial. Under SEC rulemaking, new paragraph C was added to Rule 506 to permit general solicitation under certain circumstances. Under 144A, the change was to limit sales only to qualified institutional buyers, whereas previously Rule 144A had limited sales and offers only to qualified institutional buyers. Next slide, please. However, in order to use the general solicitation provisions under 506C, the issuer and the offering participants can't be deemed to be bad actors as defined under the rule. An offering is disqualified from relying on 506C if a covered person, which is listed below in the definition, has a relevant criminal conviction, regulatory or court order, or other disqualifying event. The certification as to bad actor status, or the absence of bad actor status, if you will, are time-consuming to obtain, and this is not practical for commercial paper, which can be issued on a daily basis. As a result, issuers and dealers do not use the general solicitation provisions of 506C. They rely instead on Section 4A2. Next slide, please. An important recent change is the amendment to the definition of accredited investor. In August, the SEC adopted amendments to the definition and to the definition of QIB. They added to the definition of accredited investor any entity not listed essentially in the preceding list of entities that has at least $5 million of investments. This addition was helpful because it clarifies that municipalities and other government entities can qualify as an accredited investor. That was often an area of concern where sales were being made to municipalities and other government entities. The change also added a family office and a family client definition to accredited investor. I haven't listed it here, but it also included in the definition of accredited investor knowledge of employees of an entity that would be an investment company, except for reliance on Section 3C1 or 3C7 of the 40 Act, and also included persons with professional certifications. The QIB definition was amended to include any institutional accredited investor that was not previously provided for in Rule 144A. And contrary to the definition of accredited investor, that institutional accredited investor under the QIB definition may be formed for the specific purpose of acquiring the securities offered under Rule 144A. Next slide, please. One of the key advantages to 4A2 commercial paper is that there's no requirement to use the proceeds for commercial transactions, for current transactions. 4A2 commercial paper programs are often used to finance acquisitions until term financing can be arranged. Because issuers have existing commercial paper programs and they can immediately increase the volume of issuance under those programs, it is a very handy way to initially finance an acquisition. Proceeds can be used for any legitimate purpose consistent with the board resolutions establishing the program. Next slide, please. The disadvantages of 4A2 paper is that the paper is privately offered, which means it's a restricted security. Some investors have limits on the amount that they can invest in restricted securities. You see this, for example, in some retirement funds, for example. This might have an impact on the secondary market, but generally the secondary market in commercial paper area is the dealer market. The sales in the secondary market are almost always back to the dealers who sold the investor the paper. And the dealer may hold the paper or might turn around and resell it to other customers. Stuart, can you comment for a moment just on the kind of on the size of the secondary market and also whether the restricted security aspect of 4A2 paper has any significant impact on marketing?
Sure. So the secondary market in commercial paper does exist, but our market is generally a buy and hold market, especially for short maturities. As we mentioned earlier, there's tremendous liquidity inside of 45 days. Many investors can customize the maturity of their investment to their target cash flow requirements. So generally, it's a buy and hold market. Having said that, there is demand from investors for longer tenor securities. Banks are particularly active in issuing at longer tenors, 3, 6, 9, even 12 months. And there are occasions where, for various reasons, an investor may want to get liquidity for a particular holding. It may be they want shorter tenors. It may be they need cash due to withdrawals or changes in their cash forecast. And as you point out, typically the paper is sold back to one of the dealers on the program or the dealer that originally sold them the paper. In terms of 4A2 being technically a private placement and a restricted security, I think investors generally will look to the liquidity of the program broadly as opposed to the legal definition. So a program that has only a couple $100 million of outstandings might be considered a fairly less liquid security relative to a 4A2 program with $3 or $4 billion outstanding, considered a highly liquid security, regardless of the exemption and the 4A2 legal definition of restricted security.
Next slide, please. There we go. Because much of the commercial paper market originally started as 3A3 and then 4A2 programs came into existence, it wasn't uncommon for some issuers to convert their 3A3 commercial paper programs to 4A2 programs. Historically, there were transition issues that had to be addressed in moving from a publicly offered program, 3A2, to a privately placed program under 4A2 in order to avoid the integration of the private program with the public program. This was usually addressed by adding covenants to the use of proceeds so that for 6 months, proceeds were only used for current transactions, but sales were made only to QIBs. That is, the paper qualified for both exemptions for the 6-month period. And then at the end of the 6-month period, the integration issues were resolved. With the changes brought about by the Jobs Act, this overlap shouldn't be an issue any longer if the privately placed program is a 144A program. Because with the change to the definition of, change the rules under Rule 144A, and the deletion of the offering restrictions under 144A. The only requirement is that sales be made to QIBs. However, if an issuer is converting to a general 4A2 program where they might also sell to accredited investors, this integration issue would still exist. Next slide, please. Some issuers still operate side by side 3A3 and 4A2 programs. Historically, when issuers did that, there had to be a careful segregation of the proceeds and the use of proceeds, and perhaps different maturities between the two programs in order to deal with integration issues. Today, after the Jobs Act, the integration concern from general solicitation is removed if you're using a 144A program, not the more general 4A2 program. Stuart, do you see many side-by-side programs in the market anymore at all?
Rarely. General, it may be where we have circumstances where there was a legacy 3A3 program and there was a 4.2 program established for the purpose of a particular acquisition or particular expenditure. So it's fairly uncommon to have side-by-side programs today, just for the operational expense of having multiple programs, in which, as I said, with investors relatively indifferent to the 4A2 designation and the liquidity more geared by program size, most people have determined that it's more cost effective to have a single program and benefit from the lack of limitations on use of proceeds and maturity that the 4A2 program provides, and the consistent and similar pricing for 4A2 versus 3A3. So it's less common today than 15, 20 years ago, as you point out.
So next slide, please. As we said at the beginning, the biggest group of issuers in the commercial paper market are financial institutions. They're roughly 60% of the market. About 2/3 of that issuance comes from foreign financial institutions, interestingly enough. I want to run through for a couple of moments here the federal securities law exemptions that are relied on for these programs. And then maybe Stuart can talk some about the importance of the U.S. commercial paper market to foreign issuers. Domestic banks rely on Section 3A3 of the Securities Act for their exemption from their registration requirements under the 33 Act. However, if they are OCC registered, then they need to comply with Part 16 of the OCC's rules. The OCC has rules regarding registration of securities offerings and a requirement for prospectuses. Branches and agencies of foreign banks also rely on Section 3A2. Relying on a 1986 SEC release, that is an interpretive release that deems foreign branches and agencies to be banks for the purpose of Section 3A2. If they are OCC registered rather than state registered, they must also comply with Part 16 of the OCC rules. Most typically, it would be 16.6, which would require sales only to accredited investors. Foreign banks, not branches and agencies, but foreign banks, can't rely on Section 3A2, and they can issue directly in the United States, either under Section 3A3 or Section 4A2. So the same exemptions that would apply to any corporate issuer. I find that some banks have both a U.S. branch program and a home office program. It depends on where they intend to use the proceeds and whether there are any tensions or restrictions on using commercial paper issued to the branch to send back to the home office for use by the home office. Stuart, can you jump in for a moment and just talk about how important this market is to foreign financial institutions and any other thoughts you have on that?
Sure. So the U.S. commercial paper market is important to non-U.S. financial institutions for a couple of reasons. Number one, many foreign institutions have significant U.S. operations and therefore an indigenous need for dollar funding, but unlike U.S. banks, do not have the capacity to solicit deposits in the U.S. Therefore, the commercial paper market represents an important substitute source of funding to a deposit gathering capability. So U.S. commercial paper may be a cost-effective source of U.S. dollar funding for their U.S. operations. In addition, as you point out, a number of banks have CP programs for issuance by the home office. And so it is important to note that U.S. CP issuance can be swapped to non-dollar currencies. And depending on the current level of swap, it may be even more attractive to be issuing in the dollar market and swapping to euro or another currency and ending up with lower funding costs than can be achieved even in that foreign currency through the ECP market. So issuers, banks, or non-financial institutions based outside of the U.S. may find that a important benefit of establishing a U.S. CP program as well, that it can augment domestic financing alternatives by employing the FX market.
So next slide, please. The other important segment of the commercial paper market is the asset-backed issuer segment. At one point in 2007, the asset-backed issuer were the most significant part of the commercial paper market. In 2007, there was roughly, in early 2007, there was roughly 2.2 trillion of commercial paper outstanding. Of that, asset-backed commercial paper was about 1.2 trillion in the market. With the financial crisis in 2008, a number of commercial paper, asset-backed commercial paper programs collapsed, particularly SIVs. And today, asset-backed commercial paper programs are much less common in the market. So their volumes have declined from roughly 1.2 trillion to less than 300 billion today. As you saw in the chart, I think it's around 250 billion today, actually. Asset-backed commercial paper programs started in the 1980s. Under accounting rules at the time, the sponsor of a program could operate the program off balance sheet so that no capital was required to be held against the assets. So a company could transfer assets to an SPV, have the SPV issue commercial paper backed by the assets, and use the proceeds of the commercial paper to buy the assets from the parent. With the revision of accounting rules and other regulatory developments post-financial crisis, which made it increasingly difficult to maintain these programs off balance sheet. And much of the reason for their separate existence is gone. They're still, however, used to finance trade receivables and other short-term maturity-matched lending situations. Stuart, can you comment on the types of programs we've seen established in the last year or so, and any other comments you might have on asset-backed commercial paper?
Yes, for sure. So the asset-backed CP market, as you point out, was 1.2 trillion in 2007, and as you point out, were established largely to take advantage of accounting and capital regulation that allowed these vehicles to be off balance sheet, substantially increase the amount of assets that banks could essentially originate and fund in a very cost-effective manner, and grew dramatically. In the financial crisis, many of these programs became uneconomic. The assets ended up back on the sponsoring bank's balance sheet, and as you say, down to 300 billion today, primarily sponsored by banks who have a specific benefit from financing through commercial paper, whether that's they're financing U.S. dollar assets and they don't have dollar deposits for those assets, and so CP is a very efficient way to fund those assets, or others. But generally speaking, these are receivables-backed programs, which are financing receivables originated from corporate clients. Recently, we've seen more programs established to sort of indirectly provide funding to banks who are financing assets under repo agreements. And these, again, provide access to dollar funding, very short-term, very flexible, and sort of an adjunct to the bank's other financing alternatives. And so in addition to the receivables-backed financings, we see programs characterized as repo-backed programs, and those programs that are providing repurchase agreement financing to A1, P1 rated banks through match-funded issuance of commercial paper in the U.S. market.
Thanks, Drew. Next slide, please. So I want to pause for a moment on the 40 Act considerations for asset-backed CP programs. Because the issuer in an asset-backed CP program is generally a special purpose entity, it's not an operating company, it will usually fall under the definition of an investment company. And it's necessary, therefore, to consider what exemptions are available from registration as an investment company under the 40 Act. Previously, many asset-backed commercial paper programs relied on either Section 3C1 or 3C7 of the 40 Act for an exemption. However, with the adoption of the Wall Street Reform Act of 2010, the Volcker Rule, which was a part of that act and was adopted under the act, now requires a careful examination of other possible exemptions from the 40 Act, or possibly an exemption under the Volcker Rule itself from the definition of a covered fund. Section 3C5 of the 40 Act and Rule 3A7 under the 40 Act are possibilities, and also compliance with the definition of qualifying asset-backed commercial paper conduit under the Volcker Rule. Just incidentally, also, as swaps are used in a program, attention also has to be paid to the Commodity Exchange Act and initial and variation margin requirements under the Act. Next slide, please. Disclosure practices for commercial paper developed from the historical antecedents of Section 3A3, where commercial paper was used for commercial banking transactions. As a consequence, Section 3A3 doesn't impose any disclosure requirements on an issuer of commercial paper. Disclosure documents for commercial paper, particularly corporate commercial paper, have traditionally been very brief, providing little more than an identification of the issuer. Accordingly, the offering documents may be little more than a term sheet. This, of course, is not the case with asset-backed CP, which may have very detailed offering documents. 4A2 commercial paper, adopted the same disclosure approach used in Section 3A3. As a consequence, 10b5 letters from counsel are not utilized in commercial paper offerings, contrary to the term securities issuance market. Next slide, please. The issuing documents are relatively simple. They're an issuing agreement, an agreement with the dealers, a disclosure document, and often a liquidity agreement, particularly in asset-backed programs. Liquidity agreement is just a line of credit or some other form of bank liquidity. Usually it can't be liquid assets. Bank liquidity is important because banks have access to the Fed window. Next slide, please. Practical considerations, maturity limits on 402 commercial paper. There's seldom sold with maturities longer than 390 days, which was a limit determined by money market fund considerations. As money market funds have traditionally been very active purchasers of commercial paper. However, with the money market fund reform in 2016 and the conversion of many money market funds to government funds, the importance of money market funds as purchasers in the commercial paper markets has declined. Stuart, can you give us some sense of how much of the market today, the investor side of the market, is made up by money market funds?
Sure. So prior to the 2008 financial crisis, money market funds really were the dominant liquidity source for A1, P1 commercial paper. And that was, money funds had fairly flexible rules governing their activity as long as they stayed within the Tier 1, A1, P1 commercial paper investments. Today, money market fund rules have been changed, and money market funds are smaller in aggregate than they were back then. Today, money market funds may represent only 40 to 45% of overall purchase of A1, P1 commercial paper. Having said that, many of these managers of large money market funds also operate non-money market fund investment activity, separately managed accounts, ultra-short bond funds, individually managed accounts that are active purchasers of commercial paper. So large money fund complexes continue to buy significant amounts of commercial paper. Only a portion of that, though, may wind up in their money market fund. So the Tier 2, or the A2, P2, and P3 commercial paper market, money market funds are not a significant investor base, that being because money market funds under Rule 2A7 are required to target 95% of their activity within the Tier 1 space.
Thanks, Stuart. We're starting to run out of time here, so I'm going to skip over the next two slides on securities law liability. It's pretty straightforward, and you can read that for yourself. I'll pause for a moment on the due diligence defense just to say that with the continuous issuance of commercial paper and with the kind of bare bones offering document, the traditional due diligence defense is next to impossible with commercial paper. There are no 10b5 opinions given. There are no accountant's comfort letters given. There's no management, no questioning of management prior to each issuance that you would find in a normal debt offering. So it's not really possible to do a reasonable investigation of an issue. Some dealers establish credit departments to continuously monitor issuers, but generally issuers act defensively, and rating downgrades or headline events that can lead dealers and investors to refusing to roll over issuers' commercial paper, forcing the issuers to rely on bank lines of credit. A brief note about commercial paper funding facility as an emergency facility. It was extremely important in 2008, particularly to asset-backed commercial paper programs and foreign banks. In 2020, not so much. Just the mere establishment of the program seemed to bring liquidity back to the market. I'd like to turn it over to you, Stuart, to talk a little bit about the two slides on the and any closing comments you might have.
Okay, thank you, Jerry. I just had two slides that I wanted to share with the group, which was sort of the outstandings in the U.S. and the Euro market. I think we did highlight the substance of this first slide on the USCP market, which, as we pointed out, the total outstandings are about $1 trillion. Actually, it's a little higher today. I think it's this is as of the end of December. Now we're almost at 1.1 trillion in outstandings. As you can see, the bank sector represents almost 60%, the asset-backed sector about 250, and the corporate sector is now over 200 billion in terms of total outstandings. And this did fluctuate significantly during this year in response to COVID market crisis. As you can see, the corporate sector shrank significantly from over 300 billion in the January and February of this year down to a level sort of in the 180 zone. And as I said, it's now back over 200. And bank issuance, which shrank significantly in April, has increased back up to over 600 billion today. If you turn to the next slide, there's this is just a slide on the ECP market. Interestingly, the ECP market is about half the size of the U.S. market. It is very similar in terms of its function and operation, although it provides for issuance in currencies, many currencies other than dollars, primarily euro and sterling in addition to dollar, and but functions in a very similar manner, dealers distributing paper to money market funds and other asset managers, as well as corporations and insurance companies. The primary issuers in Europe are the government agencies, sovereign issuers and government agencies. Corporate issuers represent a much smaller percentage than in the U.S. It's only about 10% compared to about 20%. And banks, as you can imagine, are also a smaller share, that being because many of the banks in Europe do not rely on the Eurocommercial paper market, having their own indigenous deposit gathering capacity in their home markets. ABCP is also an active sector of the market, although quite small relative to the U.S. In the U.S., where it's roughly 25% of the market, in the European market, it's more like more closer to a little over 10%. But both are thriving markets today, and seeing new issuing customers who are establishing new programs for the reasons that we described earlier in terms of financing corporate or bank requirements.
Thank you, everybody else, for attending, and that will conclude the presentation.